Stop. Right now. I don't care if you're in the shower. Turn the water off. Put the fork down. The pancakes will still be there. If you're mid-text explaining why you're emotionally unavailable, you were unavailable to your portfolio first. While you were debating extra syrup, global capital was relocating, stocks gapped down, gold surged, silver broke through resistance like it was made of cardboard. This isn't a check back later moment. They didn't wait for the opening bell on Wall Street. They didn't wait for the morning coffee in London. The moment the news hit the wires on Sunday night, the algorithms made their move. And the move was violent. If you are looking at the futures market right now, you are seeing a sea of red for stocks and a vertical green line for precious metals. We are witnessing an immediate repricing of global risk, following the announcement that the United States is raising global tariffs from 10% to 15%. The financial markets are scrambling to adjust. U.S. equity futures gapped down instantly. The market understands that a 15% tax on global trade hurts corporate margins. It hurts the earnings of the tech giants. It hurts the retailers. But while capital is fleeing the stock market, it is finding a new home at lightning speed. Look at silver. It didn't just drift higher, it gapped up. We are currently trading at $87.06. That is a gain of $4.81, or nearly 6% in a matter of hours. This is what a revaluation event looks like. Look at gold. It has surged over $100 to trade at $5,164. The market is telling us that the tariff is not just a tax, it is an inflation signal. If the cost of goods is going up by 15%, then the purchasing power of the currency is going down. And when the currency goes down, gold and silver go up to compensate. We need to discuss the technical breakout that just happened. For the last few weeks, the level of $86.50 was a brick wall. The bears defended it. The algorithms sold it. But tonight, the buyers smashed through it like it was paper. We are now trading in what technical analysts call open air. There is very little historical resistance between $87 and the psychological level of $90. Some analysts are pointing to $92 as the next major technical target. This creates a vacuum effect. When a price breaks into a vacuum, it can move very fast because there are no sellers sitting above the market. The shorts who were speculating on a pullback at $86 are now trapped. They are underwater. And every dollar the price rises, the pressure on them to cover their position increases. But the most important part of this story is not what is happening in New York. It is what is about to happen in Shanghai. We are only hours away from the Chinese markets opening for the week. China is the primary target of these tariff hikes. How will they respond? Will they accept the higher costs, or will they retaliate? Historically, when trade tensions escalate, China tends to accelerate its accumulation of hard assets. They tend to move out of the dollar and into commodities. If Shanghai opens and decides to chase this rally, we could see silver push towards $90 before New York even wakes up for breakfast. We are watching a feedback loop. The tariffs cause inflation fears. Inflation fears drive capital into metals. The rising metal prices trigger technical buy signals. And the technical buy signals force the shorts to cover, driving the price even higher. It is a perfect storm for higher prices. In the next part of this report, we are going to dive deeper into the inflation trade. We are going to explain why a 5% increase in tariffs often leads to a much larger increase in consumer prices. We are going to look at why stocks and metals are decoupling, moving in opposite directions for the first time in months. And we are going to discuss the strategy for the week ahead. Because if we hold these gains on Monday, the $87 level becomes the new floor. Stay focused. The volatility is just getting started. We have to pause and analyze the specific mechanism driving this divergence. For the last 6 months, we have seen a correlation where stocks and metals often move together. When liquidity was high, everything went up. When liquidity was tight, everything went down. But tonight, that correlation has snapped. The U.S. stock market futures are flashing red, signaling distress. The precious metals market is flashing green, signaling strength. Why is this happening? It comes down to the economic reality of a 15% global tariff. To a multinational corporation listed on the S&P 500, a tariff hike is a direct hit to the bottom line. It means higher costs for raw materials. It means disrupted supply chains. It means lower profit margins. That is why the equity algorithms are selling. They are repricing lower earnings. But for gold and silver, a tariff hike acts very differently. It acts as a catalyst for cost-push inflation. If the cost of importing steel, electronics, and solar components goes up by 15%, those costs are eventually passed on to the consumer. Prices rise. The purchasing power of the dollar in your pocket falls. And historically, when the market smells inflation that the Federal Reserve cannot fix with interest rates, capital flees into hard assets. You cannot print your way out of a supply shock. You cannot lower interest rates to fix a trade tax. The only hedge is an asset that cannot be devalued by policy. That is why we are seeing silver at $87.06. The market is voting that the dollar is about to buy less and silver is about to cost more. Now look at the technical damage this move has inflicted on the shorts. For weeks, the bears have been defending the $86 level. They built a fortress of sell orders at $86.50. They were positioning for the tariff news to cause a deflationary crash. That demand would collapse. They were wrong. The market interpreted the news as inflationary, not deflationary. And when the price gapped over $86.50 on the open, all of those short positions were instantly underwater. This creates a vacuum effect. There is very little trading history between $87 and $90. There are no trapped buyers from the past looking to sell at break even because we are at new local highs. The only people looking to sell are profit takers. But the people looking to buy are desperate. They are the shorts trying to cover their losses. They are the momentum funds trying to catch the breakout. This is why technical analysts say there is open air to $92. Without a structural ceiling, the price can move violently fast. We also have to consider the psychological impact of the Sunday gap. When a market gaps up on a Sunday night, it often leaves a gap on the chart that doesn't get filled immediately. It creates a sense of urgency. Traders who were waiting for a pullback to buy are now realizing the train has left the station. They have to chase the price higher or be left behind. This fear of missing out, FOMO, is a powerful driver in commodity markets. And it is likely to intensify as we head into the Asian trading session. We are watching the clock. Shanghai is waking up to a world where their exports are 15% more expensive, and their gold holdings are 2% more valuable. The arbitrage window is wide open. If the price in Shanghai trades at a premium to New York, it will act as a magnet, pulling the global spot price even higher. In the next part of this report, we are going to look specifically at the Shanghai Gold Exchange. We are going to discuss the possibility of a retaliatory bid. If China wants to offset the impact of the tariffs, one strategy is to devalue their currency but strengthen their commodity reserves. We will also look at the key levels to watch for the rest of the night. Can we hold $87? If we do, the $86.50 level, which was resistance, now becomes massive support. The ceiling has become the floor. And from this floor, the next leg of the rally begins. Stay with us. The night is young and the volatility is high, and now the sun is rising in the east. The news has traveled across the Pacific, and the trading desks in Shanghai, Hong Kong, and Singapore are reacting to a new economic reality. We need to talk about the retaliatory bid. Historically, when a trade war escalates, the nations involved do not just sit back and take the hit, they respond. And one of the most effective ways for China to respond to a 15% tariff on their goods is to aggressively diversify their reserves away from the currency of the nation imposing the tax. If the United States makes it harder for China to earn dollars through trade, China has less incentive to hold dollars in their treasury. This dynamic creates a natural bid for neutral assets. It creates a bid for gold. It creates a bid for silver. We are watching the Shanghai Gold Exchange very closely right now. If Chinese traders interpret this tariff hike as a signal of prolonged economic conflict, they will likely accelerate their accumulation of physical metal. Why? Because metal has no counterparty risk. Metal cannot be devalued by a foreign central bank. And metal cannot be tariffed if it is already sitting in your vault in Shanghai. So the expectation is that we could see the Shanghai premium, the difference between the price in China and the price in New York, widen even further in the coming sessions. If the premium expands, it acts like a vacuum cleaner. It sucks physical inventory out of the West and moves it to the East. It drains the COMEX to feed the SGE. This brings us back to the price action we are seeing on the screen. Silver is holding steady above $87. This is critical. In technical analysis, when a price gaps up and stays there, it is called a breakaway gap. It signals a change in trend, not just a temporary spike. It suggests that the buyers are not just covering shorts, they are initiating new long positions. They are expecting that $87 is the new baseline. And if we hold this level through the Asian session, the pressure shifts entirely to the European and American traders when they wake up on Monday morning. Imagine being a short seller in London. You went to bed with silver at $82. You wake up and it is $87. You're down $5 an ounce before you have even had your tea. The panic to cover those positions creates a squeeze that can drive the price vertically. This is how markets move from $87 to $90 in a single day. It is not necessarily because of fundamental demand. It is because of forced liquidation of short positions. We also have to consider the inflationary psychology that this tariff news instills in the general public. When people hear 15% tariff, they hear higher prices at the store. They hear inflation. And for the last 2 years, the public has learned that when inflation hits, you need hard assets. This news could trigger a wave of retail buying that we haven't factored into the models yet. It could bring the Main Street investor back into the coin shops. And as we saw with the Bullion Star data, that retail wave is already building. If you combine a geopolitical trade war with a retail inflation scare, you have the fuel for a sustained rally that goes well beyond $90. In the final part of this report, we are going to outline the specific levels to watch for the rest of the week. We are going to discuss the danger zone if the market tries to fill the gap. But more importantly, we are going to look at the blue sky targets above $92. If we clear 92, the chart opens up to the all-time highs. The path of least resistance has changed. The wind is now at our backs. Stay with us. We will wrap this up with a clear strategy for Monday morning. This brings us to the end game for the opening bell. We have witnessed a historic Sunday night gap. We have seen the market instantly reprice the future of global trade. A 15% tariff wall has gone up, and capital has flooded over it into the safety of precious metals. Silver at $87 is not just a price, it is a verdict. It is a verdict that the era of cheap goods and low inflation is officially over. So, as we prepare for the full liquidity of the U.S. session on Monday morning, here is the strategic outlook. The first thing to watch is the gap fill. In technical analysis, markets often try to go back and fill the gap created on a violent open. That means the price might try to dip back down to test the breakout level. The key level to watch is $86.50. This was the ceiling for weeks. It is now the floor. If silver dips to $86.50 and bounces, that is incredibly bullish. It confirms that previous resistance has become new support. It confirms that the buyers are defending the breakout. However, if we slice back below 86, we could see volatility increase as traders reassess. But if we hold $87, if the Asian and European markets keep the bid strong, then we are looking at the blue sky scenario. The tweet mentioned open air to $92 and the charts agree. There is very little volume history above this level. When a price enters a vacuum, moves that used to take weeks can happen in hours. A $5 move in silver is now a daily possibility, not a yearly anomaly. Traders will be looking for $90 as the next psychological magnet. And if 90 breaks, the momentum chasers will target the all-time highs. We also have to watch the stock market open. If the S&P 500 and NASDAQ sell off aggressively on Monday due to the tariff news, we could see a liquidation event where everything gets sold initially to cover margin calls. But historically, in an inflationary shock, that dip in metals is short-lived. The smart money uses the liquidity event to buy the inflation hedge at a discount. So do not panic if you see volatility. Understand the driver. The driver is a structural shift in the cost of everything. And in a world where everything costs more, the money you use to pay for it must be worth less. That is the fundamental thesis for gold and silver. Finally, keep an eye on the geopolitical headlines. Tariffs are rarely a one-way street. If China retaliates, if Europe retaliates, the trade war escalates. And every escalation is fuel for the fire. Uncertainty is the best friend of gold. Chaos is the best friend of silver. You're watching history being made in real time. The $87 handle is flashing on the screen. The $5,100 gold price is flashing on the screen. The new world of volatility is here. Subscribe.